Hello and welcome back to KD's Business Tips. Mike Lapede here, talking to you in a series about what is the best structure for your business. And in this video, we're going to talk about partnerships, non-incorporated partnerships. The incorporated partnerships would be more of a limited partnership, which we'll talk about later. But in this video, we're just talking about non-incorporated regular partnerships. A general partnership, also termed as. And a partnership is very similar to the proprietor, that the business profits are one and the same with the owners. Now you'll have multiple owners, so that's the difference of a sole proprietor, but it's reported on your personal taxes the same as the sole proprietor was, but it'll be at your percentage of the business. So if you're 50-50, 50% of the income and expenses go on your tax return, okay? Now, when you look at how to set up a partnership, it's fairly easy overall, but you have to look at, how you're going to allocate that income and losses between the partners, because that's very important in the planning aspect if you're going to have a partnership. And typically, we don't recommend partnerships. They're not used a lot. But there are some benefits and certain specific circumstances that you may want to use a partnership, okay? Typically, we would rather recommend incorporating instead of a partnership in most cases. But let's go through the advantages and disadvantages so you can understand the basics of the partnership. So the advantages is because now you have more than one person with you. It could be two or more people in this partnership. You now can pool resources and capital and workloads. You can distribute, the work that you have to do. So it's not all, if you were the sole proprietor, you would be doing it all. Now, also, you would have more borrowing power because there's more than one person. So the sole proprietor was based on your credit if you were even going to borrow or get financing, which was hard to do. But with a partnership, you now have more people on the line, more people's credit, and more people with borrowing power because based on their debt ratio or income. And then as we mentioned, now we can bring in partners when we're forming a partnership with certain talents, certain skills, certain monetary resources. You can be very strategic in your partnership of who you're partnering with, because you, again, bring more people together, more resources together. You can pool talent and so forth. And those are the real advantages of the partnership. Now, the disadvantages are a little different because you're also exposed to liability. So that one is actually the same as a sole proprietor. You're completely exposed to liability, right? And now you have a little bit different, though, because in a sole proprietorship, it's not closed until you decide to close it or you pass away. Whereas a partnership, you got two partners. If one partner leaves, the partnership's done. You got to form a new partnership, right, with someone different or sole proprietor, okay? And the last thing is, the last detriment or disadvantage of a partnership is that they're very costly to set up the agreements. I mean, you have to pay legal fees to set up the agreements. So a lot of times it might be cheaper to do the incorporation, or not much more to do the incorporation of the shareholders agreement for that instead. So it is quite costly to set up a partnership because of the agreements that go into that partnership. If you have any questions, we'd love to hear from you. Post in the comments below. Please do. We'll see you in the next video.